Okay, here we go. Hello, everyone. Welcome once again to Finance Friday on the ARCUK YouTube network. I'm Hard Money Jim, speaking as usual for this time of year from beautiful Jackson Hole, Wyoming, on a day that started out rainy but has now opened up to a cloudless blue sky. I guess you don't need to get that weather report every week, but there it is. It's a beautiful day. Anyway, today we're going to continue and complete our previous discussion that I called Money Creation, Who Cares? And the main question that I want to get to today is just this. Given that money is created out of thin air by commercial banks and sometimes by their central bank, is that legitimate? Is it legitimate for banks to create all the money we use? Now, my answer to that is a little nuanced, and I'm going to take a stab at answering that question today. But before we go there, though, we should review briefly what we discussed last week. We emphasized last week that nearly everyone, citizens, politicians, teachers, economists, textbook writers, and so forth, they're all virtually all systematically ignorant of how money is created. And by this, I mean that this monetary illiteracy, as I'm going to call it, is widespread and it's very predictable. Recall, my hypothesis is that this illiteracy exists not because money creation is hard to understand, but because there's actually a psychological barrier to accepting that money creation comes from a decision by someone who's just been given the legal power to create credit. And as J.K. Galbraith said in this quote in front of you there, this idea is so simple in comparison to its importance that the normal mind just repels the idea that money can just be created out of thin air. Now, the second topic that we discussed was the actual process that creates new money. And I suspect that some of you were surprised to learn that the mechanics of creating a banknote or a bank deposit is the same today as it was under a gold standard. The banker simply makes a promise to pay out standard money on demand, and then he exchanges that promise for an IOU of some kind, a loan or a bond. Under a gold standard, the banker's promise to pay out standard money, his promise to pay out, is then it's in the form of, whether it's in the form of a paper note or a bank deposit, then trades in the economy just as if it were standard money itself. And why does this work so well? Well, it works so well because there's widespread confidence in the banking system. And now whether that confidence is based on sort of naive ignorance or not, whether it's maybe blind faith or something else, that's an open question. But the fact is that system has worked well for many centuries. Now, I want to add a disclaimer about this slide. This slide is oversimplified. The actual development of modern banking is just stylized in this slide, and it did not occur overnight. Actual development of this kind of banking, of credit creation, was marked by lots of different kinds of credit instruments tried in a number of European cities that were financial centers around Europe, financial centers of trade. And it was complex and it was messy. So this slide does not purport to tell the whole story, but it does illustrate the basic principle of behind the creation of fiduciary media that is still in use today. Now, since the demise of gold as standard money, which is basically the 20th century, while this credit creation mechanism is still the same, most of the underlying controls and limitations on money creation have changed and changed radically. The most important change is the source and control of bank reserves. Under a gold standard, the bank's depositors always had the opportunity to exchange their banknotes or bank deposits for physical gold. Gold, of course, was in limited supply. It was expensive to produce, and it was recognized as full and final payment to discharge debts. So if the bank extended too many loans, or if it did not offer an attractive interest rate to the gold depositor, if for any reason the gold depositors thought their gold was at risk, they could just withdraw their gold from the bank. And this kind of market discipline was the ultimate regulator on both the quantity of money, that is the fiduciary media, issued, and the quality of the assets that the bank acquired. In the 20th century, under our fiat money system, or at least it's a fiat system of standard money, the market discipline was no longer the main regulator of the standard money. And today, standard money, of course, is the paper currency issued by the central bank. Or if it's not the actual paper, it's an equivalent electronic deposit at the central bank that can be converted to that paper on demand. But standard money costs virtually nothing to produce. It can be issued in limitless quantities by the central bank. And so depositors can withdraw it if they're from the commercial bank, if they're worried that the bank is not going to make good to pay out its promise of paper cash on demand. But the central bank can also just print more paper bills if it wants to. All right. So with that difference between a gold standard and a fiat standard money situation. With that as a review of where we were last time, let's now ask and answer the question, given that we live under a system of fiat standard money, what does that say about bank credit creation? Does that invalidate the process? Is credit creation always phony money? Or can bank money creation be legitimate? Can bank created money be sound money? That's something I'd like to consider. So today I'm going to give you my opinion on that. And there are many different opinions among free market economists on this. So you should know that some, and especially some of the pure libertarian types, might consider my views controversial, but I think I can justify my views. So let's discuss that question. And along the way, I'm going to offer some good reading for some of you who want to pursue this topic more closely. So with that as kind of a long introduction and bringing us up to date, let's get into part 3 of money creation, who cares? And this part 3 we'll call how to tell if money creation is legitimate. How do you know? Now, to introduce this question of the legitimacy of money creation, I'd like to answer first a few questions I got from viewers of last week's podcast. And a question from John, which is a good lead into today's discussion, is he says, I quote, "I am having trouble with this idea that a goldsmith could issue a banknote worth a certain quantity of gold when it is possible that the gold did not exist." In other words, he's asking, there's not enough gold to cover all the claims on gold. I'm having trouble with that. And my answer is real straightforward. It's not merely possible that there's not enough gold to cover all the banknotes or deposits. That's a given. That's what the creation of fiduciary media, or what some call bank money, is all about. The banknotes or deposits that the fiduciary media that function fully as money are redeemable in gold, but only some fraction of those claims can be satisfied at any given time. So it is an apparent paradox, and I think this is where John is having the problem. And I'd put it this way: anyone can have their gold if they want it, unless everyone wants it, in which case virtually no one can have it. So if that seems like a paradox, let me just point out that the arrangement is pretty analogous to a life insurance company, which issues promises to pay that exceed the market value of the firm's accumulated premiums and investments. So a life insurance company takes in money, invests the money, and then issues promises to pay out in the event that someone dies. But they don't have near enough money in either the premiums collected or the accumulated investments to pay it all out. So in other words, if half the ratepayers of a life insurance company suddenly died, like in a war or a pandemic, the life insurance company could not pay out. They'd go bankrupt. And everybody knows that, and no one is deceived by it. Nobody I know considers life insurance to be an unethical business or fraudulent. The insurance ratepayer, just like the gold depositor, evaluates his risks, including the risk that the life company will go insolvent, and he decides if he wants to buy the product or not. So I would say it's that simple. Now, also, John asked, he says, I sense just a little bit of hesitation about your commitment that this is entirely ethical. Well, no, I did not intend to transmit that. No hesitation was intended at all. I regard this kind of banking as completely ethical, as long as there's no force or fraud involved. If you want to get paid, if you're a gold depositor, you want to get paid interest on the gold that you put into the bank, you need to trust the banker as an investor as well as a custodian. And if you don't want to take that risk, just withdraw your gold and store it where you feel it's safe. So, under free market money and under free banking, which obviously we do not have, and which has been rare in history, various kinds of custodians and various kinds of banks, will go into business. Some will just be custodians. Some will be more aggressive and risky with your gold. But always the issue of fiduciary media would be limited by physical scarcity and by market discipline, and not by government force. So my own view is that fiduciary media would be much more limited than it is today with our system of deposit insurance and serial bank bailouts by central banks. But it would exist. Okay, and then there's a final question. John asks, it seems you are arguing that the owner of the banknote does not really have a claim on any of the deposited gold, but only other banknotes. No, that's not true. The banker's promise is to redeem gold. And there could be different promises and contracts under different kinds of banks, I suppose. But in my example, the promise and the way the system primarily worked, the promise to pay out real gold is the main thing that circulates. The promise to pay is what circulates his money, not the gold itself. Okay. All right. Now I want to spend the next part of this session by helping you establish a simple framework that you can use to diagnose if any particular case of money creation is legitimate, and to determine that for yourself. So when you see money creation, when you see banking activity, is it legitimate or not? Is it productive or unproductive? Is it fair or unfair? Is it inflationary or not? Is the new money sound or unsound? And under this framework I'm going to propose, all you're going to do is simply ask a few questions that will apply to every instance of money creation. And here they are. We're going to ask these three questions. One, who made the decision to create the money? That is, who decided that the bank should buy the bond or make the loan? Okay. Question two, who benefits? Cui bono. Who benefits and who suffers from any particular act of money creation? And finally, you should ask, is force or fraud involved in the transaction? And actually, this third question is the most important one, and in some ways subsumes the first two. Okay, now, just to get warmed up, let's go back to the Goldsmith Bank and test these three questions. So we're asking the question assuming there is a gold standard and there is a system of free, unregulated banking. So the answer to question one, who made the decision to lend the money? Well, that's the banker. Question 2, who benefits? Well, both the borrower and the lender, the banker, benefit because both are investing to make a profit. They both know the risks and no one is harmed. They both think they're going to benefit. And third, because there's obviously no force or fraud involved in this loan, because both the lender and the borrower have voluntarily agreed to the terms, this is a win-win situation. So obviously, we declare this as legitimate banking. But now let's look at a modern day bank, and we're going to answering these questions in a mixed economy. When you have fiat standard money, can get a little more complex. However, I think this framework, these questions do allow you to distinguish legitimate from illegitimate money creation. So now suppose the bank lends money to a local entrepreneur. This is now the modern banking system. Suppose the modern bank lends money to a local entrepreneur who wants to start up a restaurant. And the banker creates new money to invest in the restaurant, and the entrepreneur creates a new food service establishment when he invests the money. And how will we do now on these three questions? First, who decided to lend the money? Well, it's the banker, because he's in the business of lending to make a profit. 2, who benefits? I think it's clear both the borrower and the shareholders of the bank benefit. The bank benefits and the borrower benefits. And finally, is force or fraud involved? I'd say clearly not. Both are knowledgeable and both believe they will benefit. Now, this arrangement, even though it involves fiat money as standard money, is consistent with the fact that both the bank and the borrower are productive. The borrower is using the loan to create a new business and a new product that people want, and it's a service that has never existed before. There's real new wealth created here that accompanies the creation of new money. If the loan is successful, both the banker and the borrower are creating real economic growth, which means creation of new wealth. So I think in this case, we can say that we can declare this act of money creation legitimate, even though we are in a fiat or semi-fiat monetary system. Okay. What I'm saying is that modern day banks, despite their restrictions and obstacles to the operation and their reliance on fiat standard money, can make legitimate productive loans that increase the money supply. And this example typifies this example I just gave of the banker in the restaurant typifies the basic design of the US credit creation system when the Fed was created. At least that's according to Lev Menand's book that we discussed last week. It was mostly private, though highly regulated in its money creation, and it was dispersed and decentralized to avoid domination by any particular state or geographical area. So in this example, I think we have, to some extent, legitimized modern banking and bankers. Doesn't mean the system is right, but the process of money creation and the bankers themselves should not be held to blame. Okay, so that was easy to analyze, right? Now let's look at a couple of other more mixed or harder examples. Suppose the bank now purchases a treasury bond for its own investment, and they do this all the time. In doing that, the bank creates new money and then lends it to the government. The banker was not forced to do this. He acted for the benefit of his shareholders to make a profit because he's going to earn interest on the treasury bond. And as long as the government did not force the bank to do something that its management didn't want to do, I would say, based on our three questions, this is a legitimate transaction and a legitimate creation of new money, at least from the banker's point of view. Now, how the government ultimately spends the money may or may not be legitimate, but the bank has no control over that. So if you grant that the government, that it's legitimate for the government to borrow funds rather than just spend tax money, then I'm going to say this is probably a legitimate transaction. But you can see where the questions are here. Okay, next example. Suppose the Federal Reserve, which regulates all commercial U.S. banks, directs our modern day bank to participate in quantitative easing by purchasing a treasury bond. And just as a review, here's what the Fed says to the bank. Purchase a bond in the open market, and we, the Fed, will immediately purchase it from you for a profit to you. Now, as you know from our previous talks, this transaction creates new money in the form of a bank deposit for the guy who sold the bond, and it also creates new bank reserves for the bank. So question one, who made the decision? The Fed, and they imposed this decision on the bank. If the bank wants to stay in business, it does what the Fed says. Okay, two, who benefits? The bank benefits in the sense that it fattens its own reserves. The real beneficiary is the investor who gets the new money, courtesy of the Fed, which is used to bid up the price of stocks and bonds and real estate all over the system, and which therefore transfers wealth from everyone else to the investor class by giving them additional purchasing power. You'll recall our previous discussions about how that worked. Finally, regarding the question of force or fraud, because the QE program was obviously unfair and not fully transparent in its intentions, I say it was fraudulent or near fraudulent in its operation. Therefore, I judge money creation via quantitative easing is not legitimate, and it's not really sound money creation. Others may judge differently, but that's my judgment. Okay, one last example. You can probably tell we're moving from the most legitimate to the least legitimate. So try this. One last example. Imagine that the Fed, at the direction of Congress, tells our modern bank to avoid lending to fossil fuel-based energy companies in the name of saving the planet. And imagine further that Congress passes a bill that guarantees any bank loans that are made for the purpose of installing solar panels on every rooftop in the city. Now, by guarantee, I mean the government is going to backstop any loan losses with taxpayers' money to take most of the risk out of these green loans that the bank makes. These are loans and money creation that would not be profitable in a free market. This is the type of directed credit that we say that we saw tried out during the pandemic, and which we are going to see increasingly in the future, in my opinion. Okay, let's use our three questions to analyze this latest example. First, who made the decision to lend or not? Clearly, it was not the banker who represents the owners of the shareholders. He might have created money, made a loan for a sound fossil fuel investment, but by these new regulations, he is prohibited now from doing so. He likely would not have created money or made a loan for the green investment, but if that's the only avenue for him to make a profit, he doesn't really have much choice. But he obviously did not make this decision. Second, cui bono, who benefits, who loses, and who loses? The industry and the companies favored by the government will benefit due to the cheap loans and due to the suppression of their legitimate competition, which is the fossil fuel industry. The fossil fuel industry and its customers, that is practically everyone, will lose because of the real cost of energy that goes way up as energy reliability declines. Third question, is there force or fraud involved? Yes, there's both. The force is in preventing the banks from investing in fossil energy, as well as the soft force, I guess you would call it, of committing taxpayer dollars to subsidize an industry that's really not economically viable on its own. This is something that taxpayers would never have agreed to. The fraud consists in representing solar panels as environmentally friendly, cheap, and reliable, with no public discussion of their economic or environmental drawbacks. So in my view, this kind of government appropriation of the money creation process to a favored industry is clearly illegitimate. And this is clearly unsound money creation in my view. But it's with us. I mean, this is the reality. Money creation is increasingly a tool of government policy, which is why I thought it important to start this podcast. It's used to hide taxes, replace normal budgeting, direct new money to specific groups and industries, and hide government costs. Money creation caused by the government is the cause of both asset bubbles and consumer price inflation, among many other economic problems. So I hope you can use this framework, these three little questions, to untangle any instance of money creation that might seem confusing to you. You know, who made the decision, who benefits, and is there force or fraud involved? Okay, now to wrap up this discussion, I've said several times in this forum that that virtually all governments will, let me check the time here. Oh, we're good. All governments will in the future increasingly commandeer or sort of hijack the banking system in order to create money and direct this money to a preferred recipient and use that money creation to exercise political power. They have this tool, the politicians, they have this tool of money creation, which they can use to direct purchasing power to their cronies and to their sort of ideological favorites. This is the exercise of raw political power through money creation. It's concealed from the average person because the average person doesn't understand money creation. But now remember, you understand it. So hopefully you are one of John Maynard Keynes's one man in a million, one person in a million, who does understand, at least beginning to understand, how inflation can destroy an economy. Okay, this is the nature of the age of the sort of, I'm calling it monetary fascism that we're now entering. It's part of the economic landscape, and it threatens, unfortunately, to delegitimize the banking industry, although I don't think it has yet. But I think you have to be able to understand it so you can deal with the consequences both in your personal financial life and in your role as a concerned citizen who has the power to vote better representatives in office. I know when I say monetary fascism, I know that sounds bad, and it is, but all is not lost by any means, because just in the last year, there's a growing understanding of the problem of government meddling in the money creation process. And I now want to highlight some people, both politicians and scholars, who are on the right track on this issue and can be a source to you of both correct information and, I think, inspiration. They also may be eventually a source of positive change. So you should get to know these people. And the first one is this guy. This is a politician who understands money creation and openly advocates a better understanding of it as a first step to restoring a sound or more sound monetary system. So I'm calling your attention to Minister of Parliament Stephen Baker. He's from the UK. He's, as you see there. In 2014, he organized the first parliamentary debate on money creation that had occurred in centuries. So watch Steve Baker and watch him and listen to him, especially if you're a UK citizen. Okay, next. Minister Baker, I guess, Member of Parliament Baker, recently co-authored a good monograph on money creation and its consequences in the online publication of the Cobden Centre, which is a UK-based foundation promoting sound money practices. And you can find them and their articles as well as Baker's article, which is worth it, at cobdencenter.org, and it's CENTRE. Remember, that's the way the Brits do it. Okay, another useful source here. Next up, here's an informative new paper by Andrew Hook. Now, I mentioned him last week when I was documenting the lack of knowledge by politicians who don't understand where money comes from, because he documented this in this paper. But Professor Hook, in addition to accurate commentary and analysis in this paper, he makes a really powerful case that the money creation is badly understood by politicians and policy analysts, and that's a potential disaster. And he's well worth reading. There's some other good things about the article too. And I should add that Andrew Hook is open to correspondence. I've corresponded with him, and he's very eager to exchange ideas. Okay. Here is an informative paper. It's actually probably a seminal paper, in my opinion, by the Bank of England, dating from 2014. And this might be the paper that kicked off the debate of money creation in England, in the UK. It's the first paper you should read and study carefully if you want to master the details of money creation beyond what I've just talked about in this talk last couple of weeks. So this paper is clearly and plainly written, and it's pretty comprehensive in its explanation of both commercial banks and central banks. And it's got great diagrams to go along with the narrative, so it's highly recommended. Okay, now we're going to get to my favorite. Here's a paper that is very important for any serious scholarly pursuit of money creation. This paper is heavily referenced by other writers, and it is frequently cited in papers around the world. This is Richard Werner's essay, A Lost Century in Economics, and I really cannot recommend this paper highly enough. It's not that easy. It's 20 plus dense double column pages with lots of footnotes, but it's really excellent scholarship, and it's well worth the effort. His history of economic thought in this paper on the subject of money creation is really superb. And one unique highlight of this paper is when Professor Werner proves how money creation works by actually taking out a loan from a real bank and then examining the accounting records for the bank. Now, for reasons that will become apparent if you read the paper, because that is actually not an easy task. And that, believe it or not, had never been done before. But in this experiment, Werner proves inductively that no prior deposit was required to create new money, no deposits or reserves were loaned out, and that both the assets and the liability of the bank increased exactly by the amount of the loan solely because of the loan. And this kind of fact-based epistemological rigor, I guess I would call it, in economics is welcome, and it is rare. So in my view, Werner fully proves the credit creation theory and should get credit. Now, there's a great quote from the conclusion of this paper, a statement that Werner made that has motivated me to pursue this line of knowledge. He says, quote, "How is it possible that for the largest part of the past century, erroneous and misleading theories have dominated the economics discipline? This is a topic for future research." Now, just think of that. He's proved that world-renowned experts, including Nobel Prize winners, have spread false theories of money creation for nearly 100 years. Think of that. It took a hero like Werner to ferret out the truth. Werner's many other papers, all available online, are also well worth your time, in my opinion. Okay. I know these are a lot of sources, but you can go back and get them at your leisure. Last but not least is a full-length book. It's the only book I know that could qualify as a good textbook on money and banking if I were selecting one today. It is an anthology prefaced by the eminent economist Charles Goodhart, with contributions from various UK scholars, including Richard Werner. So this is very good. Now, I want to wrap up with this slide again, which you've seen before. And just a reminder, if any of the explanations last week or today still leave you at all confused, just remember the monopoly slide. At the end of the day, money creation is a privilege granted to banks by legal authority. And because the law grants banks this exclusive authority, No one else can legally create money. It's very similar to the rules of monopoly. Just read it there. The bank never goes bankrupt. To continue playing, use slips of paper to keep track of each player's banking transactions until the bank has enough paper money to operate again. That's the commercial bank's credit creation. Now, the banker may also issue new money on slips of ordinary paper. That's the central bank. Okay, now let's take a quick break here. Before I have a little bit of time, and I'd like to get into a little review, an update on the housing market, just as kind of a bonus. Let's take a quick pause right here and see if there's any chats or questions.
We have no questions, but Bonnie in the members chat says, "Thank you, Jim. This is invaluable and appreciated."
Well, thank you, Bonnie. I appreciate it. So there's two ways to interpret no questions. One, you're really getting through. I mean, it's so crystal clear that people are getting it. And two, the other way is nobody cares. But it's probably a mixture of the two. But thank you, Bonnie. I appreciate it. Let's draw a line there with legitimacy of money creations. I was going to get into a little bit about how I have noticed that most of virtually all, with the exception of Lev Menand, virtually all the theorists and the writers on money creation are from the UK. And there's a lot actually that I have not even named, but they're all from the UK. And so that makes me think that if we are going to get a revolution in the direction of sound money, they may very well start in the UK, because it seems like that's where the intellectuals are. So that's something to think about. Okay, so let's draw a line there and go back to more very practical matters. And I've wanted to take a few minutes and update you on the housing market, because it's so interesting what's going on. And so I wanted to explore developments in the housing market of the last month or so, and sort of list, you might be considering buying or selling a home, or just be interested in what's going on. And obviously, I don't want to try to help you analyze your local circumstances, but there are some big picture kinds of macro data that could figure into your market research or the timing of this transaction you might be planning. So let's look at those factors. And first, look at housing just from the standpoint of house prices. Will they continue to go up or down or stagnate? And so let's look at the data first from a positive point of view, and then we'll look at it from a negative point of view. The most obvious positive point of view is the price momentum in the housing market. What you see here is the Fed's measure of median home prices. And notice how strong prices have been, especially out here, if I can find my mouse, in the far right there, in the pandemic QE portion of the graph there from 2020 on. Now notice also, if you will, go to the middle of the line to about 2007, when the market peaked and then declined for about almost 5 years, bottomed out in about 2012, and didn't reach its old level for almost 8 or 10 years. So that's a long housing recession and a pretty long period of time in anyone's life. So that's a good thing to know. Housing recessions can be pretty extensive. Okay, let's look at another data set, this time from the big realtor, U.S. realtor, not just U.S. anymore, but I guess they're worldwide. It's Zillow. And this data starts in the year 2000 and runs to the present. It's a different data set than the Fed uses. These are only the homes that Zillow lists and buys and sells. And the top line, the top graph, shows the typical house sale price in the Zillow database. The previous high was 2007 at 217,000. And the low was not reached until 2012. That was a long 5-year housing recession. And then house prices did not regain their previous high until 2017 or so. So it's a 10-year period where you were kind of underwater or treading water with the house prices. And then, of course, the big shoot up in July of 2020. So, you got like a 30% increase in home prices in a couple of years. The middle, let's see here. The middle line there on this database. So the top line is just house prices. The middle line is the change since 2000 in the dollar value of the average house. And I would like you to notice the big upward move on the right. You had about a $50,000 move from January 2020 to June 2022. That's the same amount of money that the average American household makes in a year. So what I get from that is that might create kind of a feeling of wealth, kind of a wealth effect among homeowners that might have them feeling pretty optimistic about home prices. Okay. The lower graph just shows price appreciation as a percentage of the base price, which is pretty much the same kind of a curve. Okay, the next data set is from another big real estate firm, Redfin. And, now we're getting into some of the not so positive data. The obvious thing here is the top line, which shows that even though house prices are up over 8%, for this year, they peaked in June of this year and have been declining since. Now, that's unlike the pattern of the previous 2 years. So that's worthy of note. Looks like a rollover in prices to me. Now, the next slide is very important, mortgage interest rates. This sheds some light on why prices went up so fast and why they may now be rolling over. Mortgage interest rates went to record lows during the pandemic QE. You can see that right around 2021. And that's because the Fed was gobbling up all the mortgage-backed securities, and that was sending mortgage rates, bidding up their prices and sending the mortgage rates to below 3% for a 30-year mortgage, which is amazing. Notice, though, that as soon as the Fed began to tighten and announced that it would stop buying mortgage-backed securities, rates shot up to 6%, and they've now backed off a little bit to 5.5% or so. But, doubling your mortgage interest rate approximately doubles your monthly payment. So this is obviously a big negative effect in housing demand. And this tells a similar story. Higher rates, interest rates had a predictable and kind of dramatic effect on mortgage originations, which this graph shows. Mortgage originations is a very good leading indicator of housing demand, obviously. Almost everyone uses a mortgage to buy a house, and you can see how it peaked strongly in 2021 and has fallen off a cliff on the far right there. Let's see here. We also have softer demand just starting to be reflected possibly in housing starts. Now look at the far right of the top line there. You have single-family housing permits and single-family housing starts. And, they rocketed up at the end of the pandemic recession there. But look at the very last line there. It looks like they're starting to fall off and roll over. So that is something to be aware of. There's other indicators of softer demand. what we have here is, this is from the Redfin database again. This is a 4-week rolling average of the percentage of homes that are for sale that have had their price dropped. So you can see from 2015 on over to the beginning of 2022, this number fluctuated seasonally, right? And it fluctuated between, say, 2% and 4 or 5%, meaning that most of the time, less than 5% of the homes that were sold after their price on the market was reduced. But now you can see that suddenly that has shot up to almost 8%. So that is an indicator of pricing pressure, obviously. And I think it's interesting that it was so steady and then we see such a big move. So to me, it's not necessarily the size of this move, but the abruptness of the move that is so interesting. Okay, let's see. And then we also have this interesting Redfin data on, they measure home buyer competition. This is the monthly share of Redfin home offers that face competition. I guess that it have more than one buyer vying for the house all at once. You see that number got to almost 70% in January of 22. That's a lot of competition. And that number is now fallen off quite significantly. So, and here, I guess, is finally we're progressing from positive to now I'd say this is the most negative data I saw. And this is, this slide is from the Fed, and it's an affordability index that incorporates household income, average house price, and mortgage interest rates. And the index measures to what extent, the degree actually to which a typical family can afford the monthly mortgage payment on a typical home. So it works like this: a value of 100, you see that toward the bottom of the graph there on the horizontal or the vertical axis. The value of 100 means that a family with a median income has exactly enough income to qualify for a mortgage on a median priced home. An index above 100 signifies that a family earning the median income has more than enough income to qualify for a mortgage loan on on a median priced home, assuming they make a 20% down payment. So an index of 150, which we reached in like September of 2021 when mortgage rates were so low, an index of 150 means the average family has 50% more household income than required to make a down payment and service the mortgage. And that index was up around 150 only like a year ago. But the combination of rising house prices and rising mortgage rates has now put that index below 100. Obviously, there's only 3 factors here that can improve this affordability index. Either incomes must go up, and that happens slowly, or house prices must come down, or mortgage rates must come down, or any combination of those 3. Okay, so I think this is a dramatic move in a couple of years, and it ought to make us take notice. Finally, one more data point is lumber prices. I think lumber prices are a good indication of housing start demand in the near future. And they're hard to read here because they were volatile during the pandemic due to supply interruptions. But you can see that they've fallen a lot. They're back to pre-COVID levels. Lumber price changes, I think, are a good indicator of future home price construction. So this signals a decline, a kind of a softening in new home construction, which we've seen elsewhere. Okay. Now, just this morning, the National Association of Realtors reported U.S. home sales dropped 5.9% from July 2021. That's the sixth consecutive month of year-over-year declines. Annual home sales are down 20% from the run rate of a year ago. And these look like recession numbers to me. So maybe it's a housing recession, or I don't know, based on what we said a few weeks ago, maybe it's a housing banana. I don't know. But anyway, that's a quick statistical update of the housing market. This is all USA data, but it will be similar to UK and European data, most likely. All things considered, it does seem we are at the beginning of a major housing slowdown that's going to be accompanied by somewhat lower house prices, or at least a pause in the rate of the price increase. So if we are in a recession, and as I have opined, I think we are, then this adds to that would add to the downward pressure on housing demand. So all in all, I have to be somewhat bearish on house prices with the following qualifications. First, a prolonged crash like 2007 to 2017, like the great financial crisis, is, I believe, unlikely, because homeowners are not in distress like they were then. People that don't have 5 houses and they're all levered up as badly as they were then. And the banks are not full of toxic assets that they're going to have to force sell when the mortgage payments get stop coming in. So there should be less distress selling and therefore less downside pressure. We had 30% declines across the board, almost 30% declines in home values. That was severe. I would not expect to see that in this recession. Also, we don't appear to be overbuilt like we were back then, or like some markets, like the Chinese market, which is ridiculously overbuilt. Annual new home construction in the USA is still well below its 2008 peak. So if you have a recession and things slow down, demand could come back fairly quickly, because that we're really not overbuilt. Okay. More likely, I would say we're looking at a lull in demand and, probably a slight decline in prices. Maybe it could be worse than that. I don't know. This is what it looks like to me. And this lull could last a while, depending on the length and the seriousness of this recession that is probably coming up. Okay. All right. So that's my 2 cents on the housing market, and you can interpret it as you want. And with that, we're getting near our time allocation. So do we have any closing questions or chats?
We have a super chat from Dwayne, so thank you for $5, and also a question from Stingy Student. On the topic of Britain and sound money, did you ever see Steve Baker's speech on liberty during COVID back in 2020? He has talked about quantitative easing, etc. before.
I did not know about that. Now, I have seen some footage of him speaking for an interview, but I have never seen his speech on QE. And I thank you for that tip. I'd like to look that up. That's a person I'd love to meet. He's really a rational voice, and thank you for pointing that out to everyone. He's someone well, I'm going to start following him closely. He just came to my attention about 3 weeks ago. First time I'd heard of him. So, because here I am in the colonies, we don't know about the motherland as much as we should. Okay. Thank you. I am going to take a break next week, actually probably for 2 weeks with the Labor Day weekend coming up. So I think the next time I see you will be, I think, September 9th. But take care till then. And thank you for your questions and your time and attention.